Hey there, everyone. Happy Monday, May 12th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast Redmond, Washington, but still a beautiful day. We had some rain yesterday on Mother's Day, which did affect the Keller family plans, but Mom Keller was very happy at the end of the day. We had a great afternoon together. Happy late Mother's Day to all the mothers watching, and welcome to the show. A lot to be thankful for on this particular day with a resounding upward move to risk assets. Not all of them looking at you cryptocurrencies, but most things having a pretty strong update. Obviously, if you've missed it, I can't imagine you have, but news with U.S. and China. And again, it's so similar in a lot of ways to the headlines we got with like the U.S. and the U.K. If you look at the details, not a ton of actual concrete details besides we're delaying things and we're excited about more good deals happening. It's a very soft and fluffy kind of arrangement, but the market is loving it. So if you're bearish and you're all bared up because of the macro conditions and the potential impact of tariffs, I don't know if this alleviates that necessarily. And to be clear, what bothers me is even with all of these fantastic deals that we're hearing about, things are still, tariffs are still happening. And so like there's these 10% tariffs on things. So it's making things, it's going to make things more expensive. And we've already started to see some of that. The real question is, the potential impact of tariffs and things maybe being more expensive versus the possibility that all of this is just resolved and a what seemed like a ridiculous crisis, a self-induced crisis, arguably at the beginning of April, magically has turned into a crisis that is that appears to be behind us. Let's get to the charts and talk about from a technical perspective. I mean, I would say obviously breadth conditions have improved dramatically. The S&P has powered above its 200-day moving average. I promised you many times over, we get the S&P above its 200-day, I'll have a different tone. We're here. And so you'll hear that tone expressed when we analyze the charts for sure. The VIX is back below 20. That's bullish too. So if you've been waiting for bullish confirmation, I think we've gotten it today. So I think at this point, the stoplight is green. It tells you the market is in an uptrend phase. We'll see if the S&P is able to hold its 200-day. And I think that's probably the most important thing to watch. The S&P and the NASDAQ now back above their 200-day moving average. That shows you the optimism we've gotten off of the April lows. That shows you the magnitude of the recovery that we've experienced. Now it's all about sustainability. Now it's all about holding those gains and whether we see significant further gains beyond what we've seen. And I think the moment the S&P breaks the 200-day, I'm not the only one thinking that is a very obvious stop. And I think the moment we go below the 200-day, that's when things can accelerate. But for now, it's not happening. So at this point, as promised, I think the market's pretty constructive here. Let's look at the charts and I'll show you what I mean and how I'm coming to that conclusion. So here's the S&P 500. Obviously, a big up day across the board. The S&P 500 up 3.25%. We closed the day at 58.44, and we even accelerated into the close. And so, again, we talk about summer doldrums often. We talk about sell in May and go away. The market in 2025 is doing anything but that. For now, it's sort of accelerating on to the upside. The NASDAQ composite up 4.4%. Mid caps and small caps both up over 3.5%. Everything's green. The VIX is down. VIX is down 3.5 points to a VIX around 1840. So VIX below 20, S&P above the 200-day moving average. That's a bullish trend. Now I can cite for you all the reasons why we should not go much further than this. I can tell you what a downtrend rotation could look like. If you follow my YouTube channel, which hopefully you did, we did a choose your own adventure style video end of last week, with 4 different scenarios. There is a very bullish scenario with the S&P retesting its all-time high in the month of June. Day like today makes it seem like that's a pretty clear, path forward. But there are also some very negative scenarios. And again, the point of that is to think about what could change. And so I think as long as the VIX remains below 20, those bearish scenarios seem much less likely. As long as the S&P remains above their 200-day moving average, they're flat out impossible. So, recognizing the trend and then recognizing what would tell you the trend is now reversed, vital, and we'll keep at it. Bond market sold off today, so we're going to spend a little bit of time looking at some different charts because everything moved today. Besides stocks, the dollar, bonds, gold, precious metals rotating lower today. So the TLT down about 1%. That's a bond treasury bond ETF. The yields definitely moved higher today. So the 10-year yield's around 4.45. The long bond yield just below 4.9%. 5-year point back above 4% to 4.1%. Here's a dollar index moving up 1.4%. So today's stronger stocks, stronger dollar, weaker bonds, weaker gold. That's the way I would generally describe what we saw today. The DBC, which is a commodity ETF, actually opened up pretty strong, but then traded lower through the course of the day. But the real deterioration here, natural gas prices and gold prices. I had some questions on gold stocks. A lot of them, like Newmont Mining, getting absolutely crushed today, while a lot of names had these big up moves. Some areas of the market certainly struggled today. And generally, the stuff that's down today as we get to the market carpet, and this is kind of what happens, right? As the S&P accelerates, we get people starting to really believe in this uptrend. All the stuff that has been working really well in the financial sector, exchanges like CME and ICE, pulling back today. In the consumer staples sector, grocery stores like Kroger, one of our favorite charts in 2025, pulling back significantly today. Old school telecoms like AT&T and Verizon, pulling back today. So the strongest names, the names that have been doing so well year to date, all pulling back as investors rotate away from those sort of safety plays back into offense and back into consumer technology, even cyclical sectors like industrials, as we'll see as we go through. So gold has certainly been one of the better plays. And if you're trying to buy Amazon right now and you have to take money out of somewhere, I'd probably take it out of a gold bet. And that's what many investors apparently did today. One thing that was not up today, though, cryptocurrencies. Bitcoin actually spent most of the equity session going down. Actually just started a rally here in the last hour or two. It's still down around 102,600. Earlier today, sort of before the U.S. equity open, it was pushing 106,000, really making an effort to get back to the previous all-time highs. But for now, Bitcoin rotating lower, Ethereum rotating lower as well. All right, looking at the 11 S&P sectors, you can see some big up moves in consumer discretionary, up 5%. Again, that's dominated by Tesla, Amazon, Home Depot. Tesla had a pretty good update after Friday, breaking above the 200-day moving average today, continuing to push to the upside. Technology, number 2, up 4.6%. Industrials, number 3, up 3.1%. Utilities, the only one down today, down 0.6%. REITs and consumer staples, up slightly. So those are defensive areas of the market that were sort of flat to down, kind of traditional offense in the growth space and offense in the value space, all having really strong updates here. Our market trend model, we don't formally update it until Friday after the close, but if today was Friday, our market trend model would be back bullish on all time frames. We've been highlighting that medium-term model remained bearish through Friday's close. It was still bearish. This just changed after today's session. So we'll keep monitoring this on Fridays when we update it. And as I mentioned to our market misbehavior premium members over the weekend, we do our main report, our weekly flight plan. We talked about that medium-term trend model as a way of validating the breakout. And what we talked about was if the S&P can push above the 200-day, that probably turns the market trend model bullish on all time frames. This is telling us as of today, that's where things would end. So we'll see what happens today. It's all going forward about whether we hold that level. What's interesting this week is you've got some pretty big inflation data coming out, right? Tuesday, Wednesday, Thursday, you've got CPI and PPI monthly numbers. What happens if those come in super overheated? I think the market gives back a lot of this sort of explosive upside very, very quickly, right? But that's a big if. I think there are plenty of catalysts that can push prices back down. For now, they're not doing it, though. Here's the Magnificent Seven and Friends. Amazon up 8.1%. I don't care what you think about Amazon. It's still not a great chart. I don't think that's a subjective call. Well, maybe. Amazon is one that's actually breaking above there. Some of these Magnificent Seven had not gotten above their 200-day, and that, for me, is sort of that main thing. It did actually close below the open today, so we'll see if it's able to hold the 200. 200 days around $200. So I misspoke. Amazon, not a bad not a bad gap higher today. Meta following through up about 8% today. That's after breaking its 200-day. Tesla powering above $300 to share up to 320 and change. Broadcom, we've got a real steep trend line tracking the rally in Broadcom, which I'll show you here in a minute. Apple, all of these up over 6% today. So that's a significant move. Apple was the chart I was thinking of, still, sort of threatening its 50-day, but not quite getting above there. On the downside, Netflix, and again, what the story with today, anything that's been really good year to date got beat today. There may be some random exceptions to that rule, but that's pretty much like when I'm looking around the market carpet here in a moment, it's all the really good charts we've been talking about as, all right, the market's been kind of garbagey, but here are some names that have done well. They all kind of gave back some of those gains. And that tells you, at least it tells me, that people that have been riding those things appropriately, outperforming quite well, today you're rotating out of those and maybe reallocating to some of these other names just starting to break out. Seems to be a general vibe to what we observed today. All right. Let's get to the market carpet, our heat map. As a reminder, I can see all the questions coming in on YouTube, on Facebook, on LinkedIn, and X. I appreciate you guys tuning in live. I appreciate you guys throwing in some questions as we go. Just pop them in wherever you're watching the live stream as we go along. We'll take a question or two at the end of the episode. We did an all mailbag episode on Friday, and it was a lot of fun. Some really thoughtful questions, and had some time to answer them in a little more detail. So we'll continue to do that. Another mailbag episode planned for this Friday. So just keep your great questions coming. Hopefully we'll answer it in the show. Here's what happened today. And again, upper left, technology, almost all in the green, with the exception of like Enphase Energy, which is kind of not really a technology name. It's more green energy. Everything else kind of doing well. Within consumer discretionary, your two biggest names, Amazon and Tesla, with incredible up moves. That's enough to make the XLY at the top of the leaderboard. Even healthcare, with some notable underperformers like Johnson & Johnson, United Healthcare, Abbott Labs, McKesson. But overall, the average stock did quite well. Even like a Merck is up almost 6% today. This made a new 52-week low last week to finish the week. In the financial sector, you see these red bits. Let's focus on the red because it's a way less common color. Within financials, again, it's the exchanges like SIBO, ICE, CME, all pulling back today. That's after making new all-time highs last week. In the consumer communication services sector, Netflix, as we mentioned, pulling back off of new highs. AT&T and Verizon, which have been pressing new highs last week, pulling back a little bit. Within consumer staples, tobacco stocks have been absolutely on fire, pun intended, in 2025, pulling back. And again, making higher lows, arguably, for now, but still, a dramatic pullback. Kroger, which has been one of our favorite charts to track, still sort of in a general uptrend, but certainly pulling back today. And then utilities, obviously a very defensive sector, giving back some of those recent gains. And some of these charts like Con Ed have been remarkably strong. And these are names that generally pay pretty decent dividends. And so giving some of those back. So for me, I've been waiting for the validation of the S&P above the 200-day, validation of improving breadth conditions. I've seen enough to think that the trend is bullish until proven otherwise. We'll see if the evidence plays out through the course of this week. And I would continue to say, if you get all bulled up and start buying things aggressively today, I would be a little hesitant, only because after a huge up day like this, you usually get some sort of pullback the next day. But we'll see in this environment. One headline could change that very, very easily. But I'd be watching the 200-day for sure. I think that's a stop that, people that have been fighting the uptrend that start to allocate now are going to be using that 200-day as a long-term barometer. And as long as we hold that, things are good. If we don't hold that, that's where things could unwind very, very quickly. I think that'll do it for the heat map here. Let's keep going and look at some charts here. So here's the chart of the S&P 500. And here's what happened. We're actually technically still in this shaded area. The shaded area comes back from that price gap in November. That's when I put this on the chart. And I just keep moving it over. So we're kind of right in that area. I feel comfortable sort of, thinking uptrend is the primary trend. As long as we hold the 200-day, we fail there. And I think that rotates lower. And again, I can list out a lot of reasons why I think this market feels very overextended now on the upside. But as a trend follower, you got to follow the trends. The momentum has improved. The RSI is pushed above 60. That's a bullish reading. So we're gapping above the 200-day. We're closing at the peaks, and we're pushing above there. And we'll see. 58.50 was the level from back here. That was that pullback in November. That was the upper end of this range. Let's see if we can clear above there. But I think bullish above the 200-day is pretty good. All right, looking at breadth, I actually did a video earlier today for Stock Charts TV. It's probably not posted yet, but if you keep your eye on the Stock Charts TV YouTube channel, we talked about this breadth indicator. I did a little bit of a deep dive looking at when we've had over 50% of S&P members above their 200-day moving average. The last time we went down in this sort of 25% range and then went back above 50% was here in November after the October 23 low. That led to a pretty strong, 6 to 12 month period for sure. And while I can't guarantee something similar is going to happen, we're seeing similar breadth improvement. We highlighted the Zweig breadth thrust recently on our show here. Now we're highlighting the moving average breadth, which has improved. So again, long-term breadth measures that had not turned bullish enough for me to sort of feel like this was a bullish follow through are now turned there. So I'm out of technical reasons why the market's not in a primary uptrend at this point. Here's a stoplight technique that we've talked about recently. As I've generally approached it, below 5,500 is a red light. That's where you want to be pretty defensive. Between 5,500 and 5,750 to 5,800, we want to be yellow light, kind of neutral. So I've been lightening up on more of the defensive positioning, but not really going all in by any means. Day like today, back in the we're in the green light, right? Which means we need to start to take on risk and follow this price, assuming it can go further from there. As always, good money management is key. Let's keep an eye on the 200-day moving average. That's when the stoplight would turn back to yellow. But for now, nice breakout. The cues, and again, anytime you have a breakout, you love finding random reasons why it's not as encouraging as you think. It's called a hanging man candle on the QQQ. I mean, it's not the end of the world. We'll see what happens here. And basically, the low of today is sort of the way to validate that it's a short-term pullback. But as of Friday, the QQQ going right up to the 200-day. We tested the 200-day here the last week of March. We retested that about a week and a half ago, right at the beginning of May. We broke above there today after Thursday and Friday, stalling out right at that same level. Again, now above the 200-day, that's a bullish breakout. A pullback to the 200-day would certainly make sense. I wouldn't be surprised if that kind of happens, which gives bears sort of an opportunity to sort of rethink whether this is the next leg lower. It gives bulls a chance to digest some of these recent gains. But again, the 200-day is just going to end up being so vital, I think, right about now. Newer Dow theory, as we talked about last week, the newer Dow theory is a way of validating a breakout by noting that both the S&P and the NASDAQ in this case are breaking to new highs. These are the equal weighted versions of those indexes, both clearing their March high. That's a bullish follow through on the newer Dow theory. Boy, let's talk about things that did not go up today, because there are a couple of things out there besides some of the stocks that we highlighted. Bitcoin, right, pulling back today, and it's sort of an interesting one, right? Cryptocurrencies, particularly Bitcoin, have been rallying from early April now into mid-May, and now we finally get to the point where stocks are gapping higher and pushing above their 200-day. Bitcoin appearing to stall out at its previous all-time highs. It's something to watch for sure. There's plenty of room to have on the downside and still be within a primary uptrend. But it's interesting to me as we become overbought, and with today's pullback, not quite overbought anymore. Doesn't necessarily mean the end of the world, but I'm immediately thinking back to like this November, December major top where we had a bearish momentum divergence, right? So the new high in November overbought. Maybe that's kind of where we're at now. We ended up making a new high into mid-December on weaker momentum, and that bearish divergence suggested a major top. We'll keep an eye on that chart to see if that sort of pattern materializes. For now, just sort of a pullback at this point. Gold also pulling back, the GLD, and I have a decent position in the GLD and IAU at the moment. Have not really made any significant changes to that yet, but certainly something we'll watch. Again, we have to separate the short term from the long term. I think the 50-day moving average, this 38.2% retracement, it's all around in that 285 to 290 range. I think that's plenty of room to pull back and still be within a primary uptrend. We start breaking that, I think you need to maybe question the strength of this uptrend. The momentum overall remains quite strong. On previous pullbacks that have been constructive pullbacks within an uptrend, the RSI has held 40. Be concerned when that doesn't hold on a pullback. So let's keep an eye on that this week. The dollar rallying higher, and that's been one of the big question marks really going into late April, was why is the dollar not why is the dollar not strengthening? That is, as the equity assets are rallying here in the U.S. And implied, or at least suggested, that maybe that investors weren't rotating as much to the U.S. markets. You're seeing that actually change quite a bit with the a big U.S. dollar strength. So stronger dollar, stronger stocks, weaker gold, weaker bonds. That's how things have played out, and really just an exclamation point on those trends here recently. Here's the chart of the TLT coming down here. So, basically investors that had been parking in treasury bonds, lightening up here certainly over the last week, and really accelerating that process today. Selling bonds, buying stocks is kind of the general rotation. Selling gold, buying stocks is what you're seeing here today. But certainly a drop in bonds. After the most recent rally, the RSI stalled out below 60. That's why we look at those range rules on the RSI indicator. All right, we'll finish off looking at some individual names, and then we'll take some questions. We'll call it a day here. So Tesla gapping higher. We'll look at a couple of the Magnificent Seven charts. Again, the question that I've been raising with a lot of these is, do we power above the 200-day? And I feel like I'm going to say the 200-day about 100 times on today's show, and that's for good reason. Just so many things clearly broke down earlier this year, now retracing back to the 200-day, and it's all about getting above that level. And I'm not the only one that recognizes the importance of the 200-day moving average as a way that a lot of people differentiate a weaker trend from a stronger trend. And things above the 200-day are things that a lot of people that wouldn't necessarily get into a Tesla all of a sudden feel confident getting into it. We broke above the 200-day on Friday in the case of Tesla. Today, gapping higher, of course. We did close below the open, so the open was the high mark for the day. But overall, it's a nice gap higher. So I think on any pullback, the 200-day, there's your level. That's where we were unable to clear it here in March and April. Now we have cleared it to the upside on stronger momentum. That's a bullish breakout. Meta Platforms, one of the first to really power through the 200-day at the end of April, and really pulled back there. It was the beginning of May when it actually followed through above there. Today, continuing to push to the upside as well. RSI improving above 60. Microsoft, with the gap and run pattern that we talk about, we gapped higher here on earnings, accelerating to the upside today, continuing to follow through. Microsoft's a good chart. And we've highlighted that with the gap above the 200-day and then continuing higher. That's a good chart with follow through. Right? That shows that additional buyers are coming in incrementally as we push higher, additional demand for those shares. And that's what we're seeing. With some of these things, and so many have had these significant rises over the last 4 weeks or so, drawing a really steep trend line like this. Again, it's not the world's most perfect trading plan in my opinion, but it is something that helps you quantify when we've had a nice rally, at what point do things change, right? And so I think the Broadcom chart is one of those to watch this week, because at some point we're going to break that trend line. This doesn't just shoot to the moon with this path. This is a very steep, accelerated uptrend off of the April lows. At some point, there's more profit taking than what we've seen so far. At some point, people are pretty happy to take some profits. And at that point, the price breaks below the green trend line. And so for me, it's a good chart to just keep monitoring every day to look for that break. That probably tells us that this rally off of the April lows most likely exhausted. Boy, that's where I'm at, trying to make sense of some of these charts. Again, kind of a crazy update in so many ways. Hopefully this helps you just sort of make sense of where things are moving and where things are at. Let's take a question or two, and we'll be done. Boy, a lot of speculation on a lot of things. Yeah, let's see. Thanks for watching on YouTube. Eccentric CCC, you asked, what if CPI comes in soft? Will it push the market higher? Yeah, so the general thing with this is, that's what I would generally think, right? So if inflation data, the whole reason why this market is rallying is the market had been selling off. As a reminder, looking at the chart here, the chart of the S&P was not particularly good before tariffs were announced. Tariffs were announced here, and that's after we had already sold off from the February peak to mid-March. That's when tariffs were announced, and that's when things really accelerated to the downside. We've now recovered all the way back to the pre-tariff moment and more, which again feels super irrational to me. But I've learned irrational moves can go way longer than you think they can, which is why we follow trends, even when they're crazy and unmanageably irrational. For example, you still follow them, right? So, the inflation data this week, I think, brings into question that whole thesis that tariffs aren't inflationary. And even as we've talked about tariffs on the show, I've had a lot of comments coming through on the YouTube videos like tariffs are taxes. They're not inflationary. It's not going to do anything. I mean, I hear you, and maybe that's true. But I think the inflation data, again, which is a bit of a lag because it's reported a little after, but at some point you start to see if it really impacts, if these things impact prices. Even with the great deals that have been announced, there's still a lot of tariff. Things are, more tariffed now than they were at the February peak, right? Even if it's not as much as it could have been, it still is a number. And so I think, as we track the prices of goods and services, and if those prices go up, I think that's where maybe investors that have been really optimistic start to be less optimistic because of that. So we'll see, right? But I think, higher inflation data this week, market comes back because it probably reignites these fears that maybe tariffs are still going to be inflationary, and we'll see it impact. Again, the issue is tariffs like this, there's such a lag between when they're announced and when they're actually, you start to see the impacts of it. Reminds me of the Fed making changes to interest rate policy, and then it's months and months and months before you really see the impact of those. So let's see, maybe one more question, and then we'll call it a day. I've seen a lot of great comments about all of this. RSI, let's look at this. Look at momentum. Michael, thanks for watching on YouTube. RSI over 75 plus on indexes. Yeah, so I was going to say, so at some point, I mean, I'm not sure what exactly you're looking at, but if you look at the different, I'm on the wrong screen. Look at the different indexes, right? So here's the QQQ. The RSI is around 67. I'm seeing on most indexes, it's kind of around there. Mid caps, it's around the same level. Even the Russell 2000, the RSI is around 65. So, at some point, right, the momentum gets so strong that it starts to be a negative. And I would say, like, look at the Russell 2000 chart here. What happened at major tops, right? I see two major tops here, right? The one in November of last year and the one in July of last year, right? Let's look at those two. What happened to the momentum? You had clear divergences in both of these cases, right? And that's where the price goes higher and the momentum goes lower. So that first overbought moment, that can be a major top. And that would just be sort of like a real quick peak, like an inverted V top. It's just not as common. What usually happens is the market kind of stalls out, and then it starts to roll over. And so that stalling out, when the price still goes higher on weaker momentum, that's the divergence you're looking for. So I would be keeping an eye on charts like the Russell 2000, the S&P, and others. Major market tops usually often have some divergence, not always, but usually that's a pretty important thing to look for, because a market top is usually not a moment, right? We don't accelerate into a peak and then rotate lower. Usually start to rotate lower, and so that rotation as we go higher on weaker momentum is what causes kind of a classic topping pattern. On our market top checklist, we have bearish momentum divergences as one of the key leading indicators, because it happens when the price is going higher on and the momentum starts to dissipate. So as these things are breaking above the 200-day, like the SPY, keeping an eye on momentum, looking for overbought conditions, looking back and seeing if there's some similar patterns to what we've seen at major peaks can be the key. But for now, the S&P, the NASDAQ, small caps, none of those are overbought yet. Implies that on in terms of momentum, still could be some upside here before we reach the extremes. Boy, that's where I'm at today. This is a lot to think about. That's the show. We're going to keep thinking and talking about some of these different patterns, and certainly following as the S&P interplays with its 200-day moving average. I continue to watch the show. I'd encourage you to watch the show this week as we break down some of these indexes and what they do. Momentum, volume, breadth, moving averages. These are the key building blocks to a technical conclusion that we will continue to evaluate. We'll keep you informed as those conditions change. But in the meantime, have a fantastic night. And remember, it's always a good time to own good charts. Have a good night, folks.